And now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal, the full story. Real talk about money, markets, life. Now, it's The Real Investment Show with Lance Roberts, presented by RIA Advisors.
And welcome to the show this morning. Of course, it's the second best day of the week as we get ready to wrap up a fairly good week so far in the markets. Now, yesterday, we actually saw that kind of first crack in technology that we've been talking about here for a while. You know, we've been discussing the fact that technology gotten a bit ahead of itself and that we were expecting a rotation in the markets. And we discussed that a little bit yesterday about the recent outperformance of small cap stocks versus large caps just over the last couple of days. There's been this very rapid rotation in the market as investors really have been scrambling to buy calls on small caps all of a sudden and by record levels of puts on the NASDAQ. So this reversal or this kind of rotation in the market has kind of gotten underway over the last day or so. We'll see what kind of legs that has. As we discussed yesterday, small caps are already extremely overbought, and something we'll touch on this weekend's newsletter as well. That's been a real underperforming area of the market, and as we discussed yesterday as well, is that if the economy is slowing down, if we are going to see a slower economic environment in the near future, that doesn't bode well for small caps and mid cap stocks in particular that don't have the ability to weather kind of substantial drops in consumer spending. So again, kind of an interesting bet here is if you're looking at what the market's doing right now, this bet on small caps is suggesting no recession. So you've got to really start to think about, kind of what your views are and what the expectations are and, kind of what to expect, kind of going forward. Now, as we've discussed next week, of course, and we'll get into this in more detail this morning with Michael Leibowitz, but next week, of course, is the Federal Reserve. And that'll be the next rate hike discussion that we're going to have about hiking rates in the economy. Of course, expectations since the last FOMC meeting were no more rate hikes. We were going to pause. But because of recent inflation data, employment data, et cetera, that may be changing. And again, higher rates impact small and mid-sized companies a lot more than it affects companies like an Apple or a Google or a Microsoft that have plenty of capital, A, on hand, but B, don't have to borrow debt if they don't want to. Smaller cap companies have to borrow debt. They borrow that at higher rates. And we've got a lot of refinancing for debt in these smaller companies coming due over the next year or two. And if they have to refinance that debt at higher rates, that can be problematic as well. So again, while we're seeing this rotation in the market, again, something that both Michael and I have been writing about and talking about here on the show, this rotation that started yesterday and really a couple of days ago, that may have some short-term legs, but again, from an economic front, that may be more of an opportunity to sell into and reduce exposure to small caps and mid caps than looking to increase that footprint significantly in your portfolio. So again, just something we'll have to watch. This is early, and this rotation is very much needed. We had a very bifurcated market between technology and just basically just discretionary communications and technology, which primarily is Microsoft, Apple, Google, Meta, that's Amazon, that's those stocks. Those had really, really big corrections over the last couple of days in particular. And again, we see this kind of break finally. The NASDAQ had run up, gotten to fairly overbought levels. We were 3 standard deviations above the moving average. Yesterday was really that first big crack in the NASDAQ that we've seen in a while. So again, we're still in a buy signal right now. That buy signal is very elevated. A couple more days of weakness, if we get that, will trigger potentially a sell signal in the NASDAQ, suggesting this rotation may have a bit more work to do before it's over. So again, just something we'll be watching very closely. Fridays, interestingly enough, have been some of the best trading days this year. In fact, so far in 2023, if you just look at Friday trading, the market is up 105% on an annualized basis. Now, if we go back in history and look at other years where the Friday transactions were as positive as this, in other words, 55% returns or more, those were all a collection of some of the best bull markets in history. So again, don't know what all that means. Again, we've got a lot of views out there that suggest weaker economic growth, weaker markets in the future, but a lot of the underlying investment structures are certainly looking at a much more bullish outlook here. Again, investors have been really kind of chasing stocks here, expecting a higher level of profitability and earnings for companies. But again, from the economic data, when we take a look at that, that suggests something very different. So again, it's a very, very tough market. This has been one of the more challenging markets to invest in quite some time. It's difficult because there's such a dichotomy between what the markets are doing and what a lot of the economic data suggests. And normally that isn't the case. But this year it is. It makes it challenging to invest. It's one of these years where we've got to be much more nimble, as Michael and I have talked about numerous times on the show, just kind of being a bit able to call an audible at different times just to change directions in portfolios, take advantage of opportunities. This isn't a normal market. And so if you're expecting it to act like a normal market, that's why it's challenging, because it's not. Outside of that, though, as we continue to kind of look over the course of the next couple of months, as we get into summer, consumer spending is under pressure. Now, it's interesting to watch what's happening with credit card debt. Credit card debt had a very, very big surge last month. And again, consumers tapping more and more credit to make ends meet. Of course, this is happening at the same time that interest rates on credit cards are now at some of the highest levels historically. So interest rates on the debt they're accumulating is going up, but they're having to tap more credit to make ends meet. And they're able to do that right now, at least so far. So again, that's why consumer spending has remained fairly strong. Retail sales look okay. And really on the services side of the economy, it's still in expansion territory for now. But keep a watch on that, because again, as we've talked about before, this lag effect of monetary policy takes about 15 to 18 months when it gets to credit cards and consumer spending. And we're starting to get to that point to where those lag effects are about to start to catch up with consumers. So again, this is the challenging part. The markets are saying, hey, don't worry about it, everything's fine. The economic data suggests something very different. How this all turns out, I don't know. My suspicion is that we're going to have a bit more work to do in this market over the course of the next 3 to 6 months before we get kind of an all clear that this is now behind us. But again, who knows? Maybe everything is fine and we just kind of rally back up to all-time highs. We'll see what happens here. But again, I think the big story here, as we've been talking about over the last few days in particular, is that if this rotation is beginning, then we should see money flows kind of switch from these big technology names, NVIDIA, Microsoft, Apple, Google, Meta, which we saw yesterday, and flow into some of the other areas of the markets, particularly energy, staples, utilities, real estate, which all those had fairly big days yesterday. And if that rotation continues, there's some good value in those areas of the market that have really been ignored this year. They haven't performed well at all, but there's actually some good value in those stocks with basically good dividend yields as well. So those should get a little bit of love here, at least short term in the markets. We'll see. And if this rotation begins to have some legs to it, there's a real opportunity to potentially make some money in those sectors of the markets over the next few months. Anyway, a lot of stuff to get into this morning. We'll come back, pick up with Michael Leibowitz. We'll talk about the Fed meeting next week. Jerome Powell on deck. What's he going to do with interest rates? Will he hike? Won't he hike? That's the big question right now. That's the big debate. And what does that mean for the markets? Talk about that next right here on The Real Investment Show. I'm your host, Lance Roberts. Don't go away.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
Oh, Red, I declare, I plumb missed that candy coffee. Whatever am I gonna do?
Don't you worry, little darling. We'll watch it again on our YouTube channel.
Why, Red, I never.
The Real Investment Show YouTube channel has all of our past presentations, from Candid Coffee and Lunch and Learn to special topic discussions, and all of our live show recordings preserved for you. Subscribe now to the Real Investment Show YouTube channel, or look for the link on our website at realinvestmentadvice.com.
Hi, Lance Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets. And unfortunately for many, managing your 401k plan can be difficult. There's so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA advisors to work for you managing your 401k plan. Get started right now at the website, realinvestmentadvice.com, or simply call our toll-free number, 855-RIA-PLAN, or again, simply online at realinvestmentadvice.com.
Health and financial security touches everyone within your organization. Offering benefits for all doesn't need to be complicated. Hi, I'm Tom Allen, Senior Benefits Consultant at RIA Advisors. RIA Benefits provides independent expertise to find solutions that speak to the mission of your business, the culture you want to establish, and the budget you are able to work within. Book a free consultation with me at realinvestmentadvice.com/retirement, and we'll find a solution that takes care of your most important asset, your people. realinvestmentadvice.com/retirement, realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. Bulls win in bull markets. Bears win in bear markets. Eagles soar above and take advantage of opportunity. Let us help you soar as you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791, or online at realinvestmentadvice.com.
The Real Investment Show.
And welcome back to the show this morning. So as we've been talking about here for, the last couple of days, is that, right now the markets are kind of in a moment of calm, so to speak. We haven't had a lot of economic data out this week to speak of. Last week was the big employment report on Friday. This week's been pretty quiet, but it's all kind of just gearing up for potentially for next week, because next week, of course, is the next Fed meeting. And the markets have been hoping here that the Fed is going to pause rate hikes and that they're not going to hike anymore, at least for now. And, this was kind of something that was mentioned at the last FOMC meeting, which was, Jerome Powell said, hey, we've hiked here. And he made reference to bank lending standards, which are tightening. And that acts as a de facto rate hike as well in the economy in terms of slowing down consumer spending. Because if bank lending standards tighten, they're not making as many loans. People have less capital to work with, slows down economic growth. So, the theory was, at least from the last Fed meeting, is that the Fed is done. They're not going to hike rates anymore and let these bank lending standards do the work for them. The problem came last Friday with that employment report coming in at 329,000 jobs. That is certainly, a problem. And then, of course, also consumer spending really kind of remains intact at this point. So when we take a look at a lot of the inflation data, the core inflation data, some of the sticky price inflation data, that's not really coming down. The headline inflation is coming down, and that would happen anyway. That's a year-over-year math comparison issue. We've talked about this before. As year-over-year comparisons get easier, inflation was going to fall rather sharply just from a mathematical basis. Doesn't mean that prices come down, right? Gasoline at $4 a gallon on January 1st of one year. Gasoline at $4 a gallon January 1st of next year. Inflation is zero. Prices didn't change, but because of the way we calculate inflation, inflation falls. So headline inflation is falling very sharply, but so far core inflation isn't. That's a bit of a problem for the Fed. This is going to feed into this next meeting and whether or not they're going to continue hiking rates or not. Mike, welcome to the show this morning. So, this is one of the things that we've talked about a good bit, in the past, of course, as the Federal Reserve, this lag effect of rate hikes certainly don't seem to be impacting the economy just yet, this lag effect. But, the Fed's got to figure out what to do with inflation. What are your thoughts?
Yeah, so look, I think the Fed's at the point where they've raised rates enough, maybe too much. And I think the Fed, they'll never say it out loud, but they think it. Now it's a question of how long do they keep them at current levels, at, maybe slightly higher if they go one or two more times over the next few meetings. They know inflation is going to come down, but they have a transitory problem. They were wrong on inflation when, in 2000, late 2020, 21, when the writing was on the wall. They were wrong again that it would come down really sharply. So I think they need to, this is kind of more about politics, more about narrative, and they need to remain, quote unquote, hawkish, to remain strong and possibly raise rates. But, the reason the lag effect, there is a lag effect, is because interest rates just don't hit everyone at the same time. A company that has a bunch of debt outstanding that issued a bunch of debt in 2018 and it doesn't mature until August of 2023 doesn't care that interest rates are higher. They will care in August because that's when their interest expense is going to shoot up, when that debt is going to mature and they're going to have to roll it over into new debt at an interest rate that could be 2 to 3 times higher than what it was. So the lag effect is about time. And the Fed must know, never assume what the Fed knows or we think they know, but the Fed must know that the lag effect still works. We're still an economy very heavily dependent on debt. It's just a question of when does that debt really affect the economy? And when does the stimulus that's still coursing through the system slow up enough? And for that reason, I think the Fed's kind of just at a point where they're like, what matters most is that we keep rates up here for a long time, not whether it's 5, 5.5, 5.25. And likewise, it could be 4 3/4, 4.5. But the reason they wouldn't drop it is because it just creates more of the animal spirits in other asset markets, which do generate inflation.
Well, and that's kind of the big question, though, right, Mike? I mean, what you're talking about here is this lag effect. We've talked about this for a while, right? Is this lag effect on policy?
The lag effect is lagging.
Yeah, and it's not shown up yet, and the markets are basically saying it's not going to show up.
Right.
You've got the markets sending a very different message, and from the market standpoint, the market tends to lead the economy by 6 to 9 months, and so this is the big challenge right now between fundamentals and economics and all this type of stuff that we have to look at as investors. You're getting two very, very different messages, and the question is which one's right.
Right. Look, at the end of the day, our economy is a 1.5–2% growth economy, and nothing has changed since the pandemic. Yes, there's been stimulus, and that temporarily creates more growth. But at the end of the day, we're, let's just say, a 2% economy with 5+% interest rates. That's a massive tax on economic growth. And it's not hitting yet, because, like I said, it's taken a while for that interest rate effect to hit people, right? There's just the real estate market is pretty much seized up. There's no buys, there's no sells. So the amount of people being affected by higher interest rates is so far minimal. Auto loans are going up, credit card loans rates are going up. Mm-hmm. So we will see it hurting the economy. 2022 was a low year as far as corporate debt maturities. 2023, it's increasing, but there's much more in 24. So again, when I was talking about the lag effect 6-9 months ago, maybe even a year ago, I didn't think it would last this long. But again, the mathematics behind it haven't changed. And I still think that the economy is being taxed more and more every day. And we're seeing parts of the economy that are probably in a recession. Manufacturers probably in a recession. Service sector still seems to be doing well. Parts of the economy like leisure, travel, restaurants are doing really well. Other parts are doing poorly. So, I think it's just a question of time until those interest rates truly start bringing the economy back to where the Fed really wants to bring it in order to ensure that inflation is back down to the 2% target.
Well, this and if that is the case, then right now you take a look at analysts for stock market earnings, etc.,
analysts are saying that, the quarter four earnings in 2022 was the bottom, and earnings did improve in quarter one. So we actually saw earnings tick up about $4 a share in quarter one, and now they're projecting out earnings to continue to improve into 2024. But if you're right, and we do get this economic slowdown, then earnings have to decline. So that's another conundrum. It's earnings were obviously down from last year, but they were much better than estimates, and that's been part and parcel of what's been giving the market a lift here. And analysts are expecting those earnings to continue to improve. Profit margins are still elevated on a historical basis, but they're expecting profits to continue to improve as well. So again, we go back to this dichotomy between what the markets are expecting. And of course, markets trade against future expectations. And so if expectations are for earnings to increase, then people are going, oh, well, based on forward earnings, stocks are cheaper right now, so I need to buy them now. But if that turns out not to be the case, stocks are really expensive right now, and earnings are going to have to go back down again.
Right. Absolutely. And look, we know that forward earnings get revised significantly, sometimes upwards, sometimes downward. So, we'll see where those earnings come in. But you're right. If the economy is really going to slow down, the market is really offsides. Or, analysts' expectations for earnings are really offsides. They're going to come down sharply, which will weigh on the market. But what's really interesting, and we should talk more about this, is what's the market telling us about a recession? And if we had this conversation a week ago, I would have told you that all the cyclical sectors were doing nothing all year, right? They were down. Some of them were down on the year, while the NASDAQ and the kind of high tech growth sectors were running. Then you look at it this week, and the market's saying, what recession? As those small caps, which are very, very sensitive to the economy, are up. The Russell's up, I think, 7 or 8% this week in the last 5 days.
Yeah, and we will talk about that on the other side of the break, because that's been one of kind of the interesting anomalies of the markets. We if you take a look at what's happening with options and where traders are speculating more than anything else, we're seeing all of a sudden this massive surge of people that are buying, call options on small cap stocks and record put options on the NASDAQ. So they're betting that this whole AI chase is over, and it's now, into the small cap names. It's very interesting. This market's almost bipolar. One moment it's on one thing, and the next moment it's another thing, and we're just kind of chasing whatever the theme of the moment is. We'll see if that actually works out and how it works out. But we'll talk about this on the other side of the break. What is the market telling us about the economy and kind of where we go to from here, and is the market right? As I said, markets are generally pretty good at predicting outcomes 6 months in advance. And, if markets are right, we've got a bull market ahead of us. If not, there's going to be a lot of disappointment. We'll talk about that on the other side of the break. Don't go away.
The Real Investment Advice blog. It's required reading for the informed investor. Catch it today at realinvestmentadvice.com.
Oh, Red, I declare, I plumb missed that candy coffee. Whatever am I gonna do?
Don't you worry, little darling. We'll watch it again on our YouTube channel.
Why, Red, I never.
The Real Investment Show YouTube channel has all of our past presentations, from Candid Coffee and Lunch and Learn to special topic discussions, and all of our live show recordings preserved for you. Subscribe now to the Real Investment Show YouTube channel, or look for the link on our website at realinvestmentadvice.com.
Health and financial security touches everyone within your organization. Offering benefits for all doesn't need to be complicated. Hi, I'm Tom Allen, Senior Benefits Consultant at RIA Advisors. RIA Benefits provides independent expertise to find solutions that speak to the mission of your business, the culture you want to establish, and the budget you are able to work within. Book a free consultation with me at realinvestmentadvice.com/retirement, and we'll find a solution that takes care of your most important asset, your people. realinvestmentadvice.com/retirement, realinvestmentadvice.com.
In 1999, a parafiduciary group of financial advisors were busted by corporate giants for trying to operate in their clients' best interest. These men promptly escaped from a high-cost margin environment to the Houston Energy Corridor. Today, still excoriated by their former employers, they survive as protectors of others' fortunes. If you have a problem about preserving capital, if no one else can help, and you can find them right here, maybe you should hire the RIA team.
Can't catch the whole show now? Listen to our podcast later at realinvestmentadvice.com.
So my kids know that I do radio, but they don't listen to it or anything. This guy sees me in the airport. So now my kids think, it's like, oh my gosh, my dad's really
famous.
He's famous, right? Yeah, it's awesome. He's famous.
The Real Investment Show podcast.
So we get in the car and we find a Red Robin. It's packed. We've been there maybe 5 minutes. He comes over to me. He's like, come on, I got you. Puts us in a private room at Red Robin.
You know you've made it when you're an A-lister at
Red Robin. Exactly.
At realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. A passive investment portfolio requires active risk management. It's not a choice, it's necessity. Diversification doesn't protect against risk of loss. Let us actively help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
Real Investment Show podcasts are now available from Stitcher Smart Radio at Stitcher.com.
Hi, Lance Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets, and unfortunately for many, managing your 401k plan can be difficult. There's so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA Advisors to work for you managing your 401k plan. It's a quick and easy application. Just simply click Ask a Question at realinvestmentadvice.com or give us a call at 855-RIA-PLAN. That's realinvestmentadvice.com.
The Real Investment Show YouTube channel has all our videos ready for your easy access. Now with the new and improved Before the Bell report, Candid Coffee, and Lunch and Learn replays, plus each day's radio show. Subscribe and bookmark our YouTube channel or just click on the show links at realinvestmentadvice.com.
You're listening to The Real Investment Show.
So welcome back to the show this morning. So look, this is a big challenge for investors right now. It's just a very interesting market that we live in this year. It's been very one-sided so far. We talked about this before, is that, pretty much year to date, all the gains have come from primarily 7 to 10 stocks. And we just did a report on this on our website just this past Tuesday, talking about this, this kind of weighting in the market and what's, the drivers of the market this year so far. And we've been talking about this idea of a market rotation. In fact, Michael Leibowitz just posted an article, part one of an article on our website this past Tuesday or Wednesday, yesterday, as a matter of fact, this being Thursday, time flies. Anyway, yesterday, there's an article, part one of a series talking about sector rotation in the market, how it works, why it works, those type of things. So again, this is something that we've talked about for a while that would happen, and you never know the reason why it will happen, right? There's always, we never know what causes these rotations, they just occur. And so maybe, and again, it's early to tell, but over the last few days, small caps have just been on fire. Of course, they've also been beat to death this year. Going into last week, small cap, mid caps were running a negative rate of return for the year. So, now they're positive all of a sudden, and it's good. They're playing catch up. But, over the last, few years, actually, small caps and mid caps, and especially IWM as a kind of a proxy for both, has vastly underperformed the S&P 500. So this is part of the challenge of investing, right? This old thesis about, well,
just have a little of everything in your portfolio. Have some small cap, mid cap, large cap, international, emerging markets, and you'll be fine, right? Because over time, what'll happen is things rotate from one area to another, and you make good returns. Well, the problem is that since 2009, since we started this whole monetary fantasy that we've been on with the Federal Reserve, large caps have outperformed everything by a large degree. If you owned anything else, you've lagged market returns by a substantial margin. Over the last 12 years, it's been primarily the big tech names that have been driving the market, most of the return. So again, this is kind of the problem for where we are now. What is the market? Is the market trying to tell us something? This is where we kind of left off the last debate. The Fed's going to hike rates next week, maybe. Inflation is still a problem. Economic data remains weak. And again, as plenty of headlines, right, about potential for a recession, potential for an economic slowdown, et cetera. But what's the market telling us? And this is the big challenge. And this has been a big challenge for investors all year. What worked last year isn't working this year. What was terrible last year is working this year. It was interesting. In October of last year, and every week in our newsletter, we post a lot of analysis on year-to-date market returns, et cetera, for different sectors. In October of last year, energy stocks were up 50%. Everything else in the NASDAQ was, everything else in the market, small cap, mid cap, large cap, every sector of the market, international, were negative last year in October. This year, technology's up 60% and energy's down 10%. So again, a very different market in just a few months, and things can happen quickly. Things can change fast. But what's that telling us about the economy? What's that telling us about the future? Who's right? And again, this is the big debate, Mike. This is where we kind of left off in the last segment. Is what is this all of a sudden this resurgence of small cap stocks and mid cap stocks? What's that telling us? Is it telling us anything, or is this just a speculative rotation into areas that were really beaten up in the market, or is this telling us something more significant about the economy going forward?
Well, typically you would like to see small cap stocks lead a rally from lows, but we're far from market lows. Those lows were last October. That's when, if this was a durable rally, long-term bull market, that's when small caps typically outperform, when the economy's set on a nice glide path for at least a few years higher. But these rotations have been so fierce, so quick. We have followed it for weeks that small caps and like those cyclical sectors, industrials, materials, even staples, utilities, have been just oversold. On SimpleVisor, we have some pretty cool charts that allow us to, or tables that allow us to see what's overbought and oversold. And we talk about them every day. And every day we've had, for the last month or two, we've had the discussion. Tech and consumer discretionary are very overbought. Everything else is oversold. And especially the cyclical sectors are the most oversold. And then all of a sudden, a week later, and it's just flipped on a dime. So to me, this feels a lot more like speculative rotation than a true lasting rotation. And that doesn't necessarily mean that what we saw in tech and large cap in those 5 to 10 stocks is necessarily the long-term trend either. I mean, I just think that this market is just looking for the next big 5 to 10% gain in a week and jumping on it. AI was in vogue last week. Now it's small cap stocks, mid cap stocks. What's going to be next week? And it makes it extremely difficult for investors because the moves happen so suddenly that if you weren't in it before it's almost impossible to catch it before a huge gain. And the problem with being in it before it is that trade can languish for months, right? We knew at some point cyclical stocks, materials, industrials would kind of snap out of their funk. We didn't suspect it would all happen within days.
Right.
That's not the way markets. Rotations typically happen over time, and they give you plenty of time to get in, see if it's real, exit if it's not real, get back in, and eventually ride that rotation. what we're seeing today feels, it's a game of hot potato that's being played almost on a daily basis. What's the hot sector? What's not?
Well, but we see that in the options market too, Mike. I mean, all of a sudden you've got record put options on the Qs just in the matter of a couple of days. You've got record call options on small cap stocks in the matter of a couple of days, and this is very speculative in nature. I mean, this is, and we've seen a lot of this over the last couple of years, really, ever since kind of the pandemic bailouts where we flooded the system and really started to turn the market into a lot more of a casino type environment where, we were chasing meme stocks like GameStop and others. Then it was SPACs, and then it was IPOs, and then it was energy stocks. Then it was the next kind of du jour. But this market, to your point, has been like a game of hot potato. It's just jumping from one speculative kind of frenzy to another, and all the investors are just running in and going, okay, there's where we are. Let's buy options on it, and we see this massive surge in options. And of course, we're also talking about these zero DTE options, these 0 days to expirations, which have become a real thing over the last year, which is even more speculative in nature. We're not even buying stocks anymore. We just buy the options that are going to expire within 24 hours to see if we can catch a move.
Right. And the options volume is off the charts. And I think what's important to understand is that when there's obviously two people on each side of an options trade, and quite often Wall Street's on the other side of a trade. So if I buy a call on Apple stock and Apple stock starts rising, that dealer, because unlike me and you, the dealers aren't just, if I'm long the call, they are short the call, but they're not betting against Apple. They're really in it to make a few cents between the bid offer spread. So they're hedging everything. So if I buy Apple calls and Apple stock starts rising, they have to slowly start buying Apple stock. So the more calls, the more options out there, the more underlying dealer hedging has to occur. And when everyone's on one side of the table or the other, as far as option traders, it tends to push some of these stocks, which lead the markets, in probably more in one direction than they otherwise would have gone. So and again, a lot of this options trading is speculative. It's not you're not buying a zero, an option expires in a day or 2 days or 6 hours because you're an investor. You're buying it because you're speculating.
Right.
And it's very hard to quantify its effect on the market, but it's clearly having a big effect. And we certainly see it in some stocks, but it seems like it's spreading to the broader markets, broader indices, and it's just going to create more volatility. And look, the volatility index is dirt cheap right now, but the VIX measures longer term options, and those options are used more for hedging, more for there are more investors in the longer term options than the shorter term options, which are much more speculative. So I say more volatile, but if you look at the VIX index, you're going to say, what are you talking about? It's very low right now. But the volatility between these rotations in the sectors, right? The market didn't go anywhere yesterday, but the Russell was up, 1.5%, and the NASDAQ was down 1.5%.
Yeah.
So it's this, the markets, the broad indices, the S&P may not be going anywhere, but the volatility or the discrepancies and divergences between the prices of its underlying stocks seems to be, at some of the highest levels we've seen in a long time.
Well, and actually, you touched on the topic I wanted to touch on next, which was the VIX, because there is a very interesting story behind the VIX and what it's telling us right now, and, well, I should say what it's not telling us. And we'll talk about that after the break with Michael Lebowitz. Don't go away.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
Oh, Red, I declare, I I plumb miss that candy coffee. Whatever am I gonna do?
Don't you worry, little darling. We'll watch it again on our YouTube channel.
Why, Rhett, I never.
The Real Investment Show YouTube channel has all of our past presentations, from Candid Coffee and Lunch and Learn to special topic discussions, and all of our live show recordings preserved for you. Subscribe now to the Real Investment Show YouTube channel, or look for the link on our website at realinvestmentadvice.com.
Hi, Lance Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets, and unfortunately for many, managing your 401k plan can be difficult. There's so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA advisors to work for you managing your 401k plan. Get started right now at the website, realinvestmentadvice.com, or simply call our toll-free number, 855-RIA-PLAN at realinvestmentadvice.com.
Small businesses are now being challenged by the lack of employees and how to attract and recruit the best employees. To get the better employee, you'll have to offer a better package. Hi, I'm Tom Allen, RIA Advisors Retirement Plan Consultant. Don't assume a 401k plan is too costly or complicated for your small business to offer. Let us show you how to make the most of an affordable and effective plan that will deliver true value for your business and your employees. Call me toll-free at 855-RIA-PLAN or online at realinvestmentadvice.com. That's realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. Manage risk and volatility rather than trying to manage gains. You don't have to be right all the time. Long-term investing success is a 70% gain. Let us help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
The Real Investment Show.
Welcome back to the show this morning. So just real quick, Mike touched on the VIX, which is the volatility index. And I guess the question, Mike, is the VIX just now completely broken because of what's been going on in the markets? You know, yesterday we saw the NASDAQ sell off pretty decently, and the volatility index on the NASDAQ is sitting at basically some of its lowest levels. It didn't even move yesterday. So, right. The VIX used to be a decent measure of a pickup in market fear, right? So if the markets are selling off and there's more, kind of more of a fear of a deeper decline, volatility index is typically rising, but doesn't seem to be really telling you much of anything right now. Is this just a short-term anomaly, or is it just permanently broken at this point?
Well, again, it's calculated off longer-term options, and no one seems to be trading longer-term options anymore. So I would just say it's kind of missing the action right now. I still think it's a very, it's something we should pay attention to, but I don't think, because the VIX, it's trading at 13 or 14. That's a very complacent level. Basically, it measures how much stocks are expected to rise or fall in a year using options, and it's a statistical measure. Typically, on average, the VIX is kind of 16 to 18. It's been as high as 70s, 80s when the market's really selling off. And I believe it got below 10 at one point, prior to the pandemic, and possibly, I don't think during the pandemic, but prior to the pandemic, it was kind of flirting with 10. So historically, the VIX is showing that investors are very complacent. They may be. Certainly there are some indicators saying that, but it may also be that investors are just hedging themselves in different ways. Either they have more money in cash, so they don't need to hedge. They're using short-term options, which don't really register in the VIX calculation. So it's not that it's invalid. It's just that it's not necessarily as, important to follow for right now. Doesn't mean we don't follow it. We do look at it every day. But, the way the market's trading is changing a little bit, whether it's temporary or permanent, we don't know. But it's got a very, it's weird because when you have these very speculative markets like this, the VIX tends to rise. The VIX was over 20 leading to the dot-com crash in the late 1990s. So, even though technology stocks and stocks were going to the moon, the volatility index was slowly rising with them. And we're just not getting that at all today. So it's hard to know what the VIX is telling us and isn't telling us because of the way it's calculated. But, I definitely recommend paying attention to it regardless.
Yeah. Again, this is just another one of those challenges to a market that's become very speculative in nature, at least at this point. And will this end? Will it change? Or is this the new dynamic? I mean, we've talked about the issues of passive investing and how passive investing is now. And when we say passive investing, we're talking about ETFs. And really saying passive investing is not an accurate description because people trade ETFs all the time. It's just they're trading, it's easier to trade an ETF than it is to buy individual stocks in a lot of cases. So they buy ETFs, they're cheap. They get market exposure. But they're trading those just the same. So they're actively trading ETFs. But because of those dollar flows into ETFs and, those create a very, lopsided flow of capital into the biggest stocks in those ETFs, which, Apple, Microsoft, Google, we've talked about this issue. That's really changed the market dynamic from what it used to be. And when ETFs were first coming up, they didn't really matter that much. Now they matter a whole lot, and it's changed the game. And so a lot of these indicators that, we've looked at for decades to provide clues as to what the market's going to do, they may not work anymore. This is going to be a big challenge, going forward, is figuring out, kind of what this new dynamic looks like. Or do you just give up the ghost and just finally just give in and buy indexes and just go home? How this turns out, I don't know, but it certainly has become a lot more challenging environment.
Right. And I guess another question is, are passive investors becoming actively passive? So by that, I mean, traditionally a passive investor would buy, 60% stocks and 40% bonds and essentially, spread out those stock purchases among 4 or 5 indices. So they have broad diversification across all types of stocks, small cap, mid cap, large cap, tech, international, something like that. Mm-hmm. Is it possible that we're starting to see those investors now starting to trade, even, 401k accounts, trading their 401ks actively so that they're trying to keep up with the market? A month ago, flip into whatever options they have in their 401ks or, to buy kind of AI high tech. And now starting to say, I got to get into small cap. So instead of having a 5 or 10% allocation to small cap, we're starting to see investors with 30 or 40% allocations. Again, still 60% stocks, but within those stocks, they're starting to rotate quicker. And I don't have the answer to that, but it's interesting to see if passive is in a way becoming active.
And it's kind of interesting too, because, you're a CFA, you went through the CFA exam and Nick in our office, he's in the middle of it right now. And, I have conversations with him, about what he's learning and where he is in the cycle of his exam. And, a lot of the stuff that, he's being tested on is stuff you and I grew up with, 20, 30 years ago. Right. And it's kind of interesting that, the markets are changing and, but we're still teaching and educating people in the system based on stuff that is from theories of, like Harry Markowitz and others about diversification, all these other type of things. Theories that, matured back in the 70s and 80s are still being taught today, even though the market game has changed so much. And do you think there's going to be a point to where, these, certifications, et cetera, that, we teach people, are going to have to change to adopt to this kind of new reality of where we are with, money flows and hedge funds and online 24/7 trading, et cetera?
Yeah. And Lance, the one thing, ask Nick when you see him, the one thing that was not on my CFA test, and I'm 99% sure is not going to be on Nick's CFA test, is the Federal Reserve. Yeah. It's liquidity. Right. And I think everything you're kind of alluding to there is a function of excessive liquidity. That's what drives speculation. And the fact that, the Federal Reserve should be a section of the test on its own. You should have accounting, equities, derivatives, fixed income, portfolio management, ethics, and the Federal Reserve. The Federal Reserve has become a big part of the market, like it or not. Some of what they do, they directly affect the market. Some of what they do is more through psychology, through their narratives, but it doesn't matter. Everyone should be grounded in the Federal Reserve, who they are, why they do things, what the effects of their actions are, the history of the Federal Reserve. And, when we try to answer, is this a new market or an old market? It's a new market. The market, when I took my CFA in I guess it was the late 90s, the Federal Reserve was powerful, but it wasn't the end all be all. Now it's become much more powerful, especially because of QE.
Right.
The Fed still owns, what do they own, 7-8 trillion of securities, making it one of the biggest quote unquote investors in the world. What they do really matters. What they say matters just as much. And, it's not just Jerome Powell. There's, what are there, 12 Fed presidents, 11, whatever it is. Every time one of them speaks, it matters, especially when they they extend the boundaries of what the Fed is, what we think the Fed is thinking.
Well, it's a great point because, back in the 90s, if you asked somebody on the street who the Fed chairman was, they couldn't tell you. And if they were invested in the markets, they could tell you it was Alan Greenspan. But they couldn't tell you who the names of any of the other Fed presidents. They were behind the scenes. Nobody knew who they were. Now everybody knows, Kashkari and Mester and all the other ones because they're on TV all the time. They're in the headlines all the time. To your point, this is a very different market we have today where these guys have basically become front and center of the market versus, where they should be, which is way behind the scenes and nobody ever knows of them.
So here's a great example, Lance. My wife I don't think she's ever listened to our show. If she's read more than 3 paragraphs of my articles, I'd be impressed.
Yep.
She showed me the other day that Jerome Powell was they're not the Grateful Dead, Dead and Company, I think is their current name. The remnants of the Grateful Dead were playing here last weekend. She goes, "Hey, did you see Jerome Powell was at the Grateful Dead show or the Dead and Company show?" The fact that she knew who Jerome Powell was, and could, that saw the picture and knew it was him. That tells you a lot about how much more notoriety the Fed president has. I don't think she could tell you who Greenspan was.
I agree with you. Real quick here before we wrap up the show. Parents are now stepping into the kids' workplace. So, Mike, you have a new role as your kids go out into the workplace. Anxious parents have shepherded their kids through high school, college, and the pandemic, and now they are entering the workplace. This is according to the Wall Street Journal. Recruiters and hiring managers say they are seeing an uptick in parents inserting themselves into their children's professional lives, calling up hiring managers, applying for jobs on their behalf, and even showing up on the job to help mediate conflicts.
Yeah.
It's called cut the cord, people. You gotta let the kids go and fend for themselves. Otherwise, they're not gonna learn. Jeez. Parents, come on. All right. Wrap up the show today. Mike, thanks so much. Get by the website. Our newsletter will be out tomorrow. We've actually got an article out tomorrow coming out talking about recession indicators and what they are telling us and what they're not telling us. That's going to be published tomorrow on the website. Our newsletter out this weekend. Of course, get Mike's latest article on the first part on sector rotations. And you can instructions on how to do it yourself on simplevisor.com. That's on the website as well, realinvestmentadvice.com. While you're there, send us your questions, comments, emails. Let us know how we can help you. Happy to do it as always. And tomorrow, tune in. Financial Fitness Friday with Danny Ratliff and Richard Rosso. See you then.